All right, thanks for joining us this afternoon or this evening, depending on where you're at. This is Brad Johnson with Vintage Capital. I have my COO, Ian Fisher, is with us on the webinar here. You're going to be able to ask questions in the comment section. We'll get to those at the end of the presentation. We have a fair amount we want to get through. We're not going to focus too much on any individual aspect, but we will be recording this. So if you want to revisit, you'll get a link to the recording as well if you can go deeper on some of the individual slides. So don't worry if I fly through a slide. All right, so let's get started. Mobile home park investing. We're going to go into the weeds on frameworks for sourcing, strategy, and operations. This is not just going to be a traditional, hey, this thesis for this industry is great. We will cover that at the end if we have time, but this is more about boots on the ground, operations, and acquisition strategy, and then aligning that with the actual operating partner. And so let's get going. So why listen to me? Why listen to Ian and I, Vintage Capital? Well, we have quite a fair amount of experience in the space. We've been doing it for 12 years. I assembled the portfolio as an operator. That's about half of that, 4,000 pads. Sold that portfolio during COVID. Have been doing joint venture partners, minority, equity, GP investments. Since then, we have a great track record of consistent returns on both funds and on individual syndication deals, and have put a fair amount of money to work in the space. Here's our quick bios for the leadership team at Vintage Capital. Once again, you can revisit this with the recording, but the main background on me is I started as an institutional real estate acquisition guy in private equity, also worked in real estate investment banking, had a lot of more traditional experience in commercial real estate before going off and becoming an operator after I identified mobile home parks 12 years ago as a niche asset class that I wanted to be a part of. All right, so agenda. So we're going to talk about frameworks first, and then we're going to talk about how you drive alpha today. This is not a beta market where you get to just benefit from cap rate compression or just the general trend of people getting more comfortable with mobile home parks. You know, it's not the secret is certainly out with the private equity groups. It's not to say that there's not opportunities to pick off deals. There certainly are, but it's not like it was 12 years ago when you can pretty much just buy anything at a 7-8 cap and enjoy the benefits of cap rate compression. So we'll get into alpha on operations, then lessons learned, and then if we have time, like I said, we'll do an update, a refresh on the thesis, and then do the Q&A, provided we have time. All right, frameworks. All right, how do you win? It's pretty simple. It's not easy, but it is simple, right? You have to match the park, the property, with the strategy, with the market, with the operator. Now, this might be intuitive to just about anybody who works in real estate day to day, but I think it's actually a little more specific with mobile home park investing because it is not a passive type of operation. This is not triple net real estate investing, as some people would lead you to believe. The thesis is great, but it is an operationally challenged business. And so you have to make sure that all these things are in alignment if you're going to generate outsized returns today. All right, so let's start with the park. Making sure that we're all talking about the same thing here, right? Because sometimes people say, hey, I want to invest in mobile home parks, and they're talking about coastal properties that look like retirement communities on the coast of Florida. Or sometimes a different person's talking about a 2-star trailer park in Ohio. So here is the star system. Fannie Mae came out with this paper where they tried to bracket what the type of deals that they want to put loans on, right? Fannie loves this product. Fannie and Freddie, frankly. So they tend to, they'll just hold, they're going to dismiss 1-star. That's think trailer park, think property you're not going to want to drive through at the middle of the night. Small, scary, right? So that's not what we're talking about today. That's not what we've ever invested in. A level 2 mobile home park, you know, starts to feel like a trailer park, but it's getting closer to what I would think of as a mobile home park, right? Where the homes are a little bit nicer. There's not a giant crime element. The infrastructure is serviceable, right? But then really where you start to get the bulk of the investments that that we're going to focus on, and most of the major players in this space, private equity firms want to see, including Fannie and Freddie, is level three and up. And you can get some real cap rate compression by or multiple expansion by moving a park from one level to the next. The easiest is taking something that's like a 2.5 star, moving it to a much nicer, safer, affordable community like a level three here. Level four starts to look more like manufactured housing communities, is really the name that people in the industry like to push. Most people think of these as mobile home parks, regardless of the star rating here. But level four and up, you start to look once again like high amenities. They look like subdivisions, right? Especially level five. It's really hard to distinguish a level five mobile home park from a stick built subdivision, other than obviously the material of the home. Oftentimes they will be set in a foundation just like a regular mobile home. It won't even have skirting. It will just be set like a normal home. But we tend to not play in the level five. Level five is more like a bond from a pricing and risk return standpoint. We tend to play in the level three and four, and occasionally we'll do like a 2.5 that gets upgraded to a level three. If you want to go way deeper on the individual aspects, you can go to our website, vintage-funds.com, and look at a resources page to get into like the line item detail of what Fannie and Freddie are looking for when they're evaluating a mobile home park from this star rating schedule. So once again, not trailer parks, right? We are investing in nice, safe, clean, affordable communities. That last one is in Helena, Montana. It's probably one of the nicest parks in Montana. This one is more common for a 3-star park, something you'd see in South Carolina, Tennessee, North Carolina, right? Where the roads are a little bit smaller. It doesn't look like a subdivision per se, but the homes are in good shape. The tenants are showing pride of ownership in their individual lots and homes. And there's even some off-street parking here. The strategy, all right, so we've kind of defined the types of parks. Now we got to align that with the strategy. So first here we have Core Plus. This is something that you're going to see in a market like Phoenix, very dense infill locations. You're not going to have a demand problem here. The key feature of investing in these types of parks is buy it at a reasonable basis from mom and pop, ideally, and then hold on, right? Because this location, its highest and best use is probably not going to be a mobile home park long term. It's going to generate really regular cash flow streams, provided you didn't make any egregious mistakes in due diligence, right? So you have to make sure, because demand's not going to be an issue here, you have to make sure you're not going to lose money on the expense side or make a mistake on infrastructure that's going to lead to a giant bill that you didn't account for in your underwriting. So once again, this requires patience and scale because these don't sell that often. And when they do, you want to be able to have the scale to not only have your feelers out to find these, but also have the amount of capital needed to buy a deal like this. It's not going to go for a super cheap value. It's a fairly efficient space at this level of a park. And you're also going to need some scale benefits to keep expenses down, like insurance. If you have a portfolio insurance policy that drives down that expense across your portfolio, certainly helps when you're buying a property like this. Private equity loves these types of parks. Especially if they can get it for a reasonable price, of course, but they love to play in this space. The hard part is just finding enough deals to satisfy them. Value add. So this is our bread and butter. It's where we tend to focus the most of our portfolio on these types of deals. They often are not in the middle of a dense urban location or the middle of a city. Oftentimes they're right on the edge of the city. Maybe they're even 30 minutes outside of an MSA, sometimes 45, depending on how large the MSA is and how strong it is from an income and population growth standpoint. So you're going to have more space. The name of the game here is justifying the rent increases, because most of the time you're buying one of these from mom and pop that have not kept rents up with market. You used to, 10 years ago, maybe you just came here and passed out a rent increase notice and you were buying it so cheap that you barely had to keep the wheels on from an operational standpoint in order to generate great returns and sell it for a much higher multiple. But today, that ship has sailed. You really do have to drive operational improvements, NOI growth, and reinvest in the properties to justify those rent increases. I like to think of this space, the real value of this space is being able to get 5+% rent increases over a very long period of time. Maybe you have to do it, some higher rent bumps in the early years just to get it closer to market so you can support your debt service, but you don't have to raise the rent 100%. And you don't need to, you need to do a lot more than just passing out those rent increase notices to drive returns on these parks. You want to reinvest back into the infrastructure. You want to enforce the rules, make sure the tenants are paying on time. They're not getting 3 months behind because that's when they get in trouble. Maybe there's some light value add on infilling some vacant pads or swapping out some park-owned homes that are a little dilapidated with brand new versions. Maybe you're adding some amenities like a playground. You could add a pool, maybe a community center, but it's not major capital improvements from a structure standpoint. It's usually roads and perhaps some pipe upgrading if your due diligence comes back and there's too much wear and tear on the pipes. So this strategy requires having your operations dialed to make sure that you can actually execute on the value add plan. And then on the furthest risk return side of the spectrum here is a heavy lift infill project, or I put a park owned home heavy project in this category too. That just means most of the homes are owned by the actual park and they're renting out the homes and the lot underneath the home to the tenants. That's not the main business model in this industry. The main business model is getting that lot rent income, which has very high profit margins. But sometimes, especially in the Southeast, you have to get in the park owned home game. If you want to drive occupancy gains quickly, the easiest way to do that is to bring in homes yourself and rent them out. And then over a few years, get those homes, those rentals off your balance sheet. Fannie generally wants to see 30% less in terms of the number of park owned homes with a property. So if you have a park that is 50, 75% park owned, financing on acquisition is going to be a little bit challenging. Maybe you have some seller financing component to bridge that gap, but then you're going to want to, over the next 3-5 years, get those homes off your balance sheet so you increase your liquidity on a refinance or sale that Fannie can actually finance the property at exit. And generally, you don't see too many groups go through this heavy infill and then keep the projects long term. And mostly that's a function of just the amount of capital that's needed to turn around a 50% vacant property. If you're buying homes, you're bringing in 50+ homes, you're spending millions of dollars on the homes, and oftentimes, syndicators don't have that kind of firepower or the team to pull that off. So this the key here is vertical integration with a deal like this. You need to make sure that you control the mobile home movers, the install guys, the skirting people. They're going to hook up all your utilities. So you need to have some construction expertise in addition to just property management and of course acquisition expertise. So then the returns, right? So core plus, right? We're thinking 10 to 13% is pretty common. Obviously, there's outliers in either direction. Really, the sovereign wealth funds, the insurance companies, they will go true core, like an 8-9% return. That's not the place that we want to play. But they view it more like a bond and just parking money at a low leverage basis. Value add, you're going to be looking at mid to high teens, depending on the market and what basis you got it at and how under market the rents are, of course. And then opportunistic, pretty typical. Most of you guys on this webinar will know the return expectations for an opportunistic deal, but you want to get paid for all this work. Infilling, doing a major turnaround is extremely difficult. It requires a big team. It requires a lot of effort. You can't do as many of these as you can value add or core. So you better get paid more. And so that's how we think about the risk return here. And so we like to sprinkle in, some on the outsides here, but once again, the value add deal is our bread and butter. But you do every once in a while see some unique deals that pop up in either of these categories on the edges. So focusing a little bit more on that infill park owned home conversion because it is such a difficult strategy to pull off, but if you do, you can generate amazing returns. Here's what I mean about vertical integration. The toters that actually are positioning the homes within the park. This park here at the top is in North Carolina. It's one of the parks that we've invested in. Brought in 50 plus homes with our operator here, which is just a ton of work. It doesn't sound like it would be that difficult, but you're just having to line so many things up from a utility standpoint, permitting, certificate of occupancy for each of the homes, depending on the state, rehab crews, you name it. So uh, here's the picture of the middle here. One of the homes skirted. There's a brand new home. You really don't have to do a lot once you get these things moved in. You skirt them. You want to add some landscaping, a little bit nicer than this long term. Put in a little stair deck, hook up the utilities, and you're pretty much ready to rent or sell this home. And then you have the toter here in the bottom here moving in a home, a multi-section home. And last point on the rentals here is that we've talked about Fannie doesn't love them above 30%. Still a great strategy to drive alpha, getting good at park owned homes. But just be mindful that while yes, it is a way to increase occupancy quickly and get your cash flow yields through the roof because these things generate a lot of extra cash from a rental standpoint. And there's good returns on the homes themselves if you're buying and moving them in. It does reduce the liquidity because it reduces the number of buyers that could effectively purchase this asset because they can't get the great financing from Fannie and Freddie. All right, now you got to align that park and that strategy with the market, right? So you can't do an infill strategy in a really soft declining market. Pretty obvious, but I see people make mistakes with that. They get maybe the park right from an infrastructure standpoint, but they miss it on the market or they miss it on the operator. And so let's make sure we don't do that. So starting with deals on the West Coast, obviously the West Coast is more challenging from a regulatory environment. So I think of this market from a selection standpoint, you got to be working with an operator or yourself be an operator that's just very, very good in that region, knows every single regulatory code, knows how to still drive NOI growth without raising lot rents. A lot of times that can involve putting in some RV lots, increasing some storage, ancillary expenses, but just being very good at operating in very specific markets. So this is a knowledge pros market. Unicorn hunters. So I love parks in the mountain states. I haven't been able to invest in a lot of them there just because there's not as many of them and they don't trade that often. So once we do find one in a solid market in the mountain states, we tend to move pretty quickly. The Midwest, I suggest caution in the Midwest. There's a lot of parks here. There's a lot of turnaround opportunities. The problem really is more of is the income there. The income in these markets, from a personal standpoint, yes, the thesis still works, right? The homes are not leaving. There's no turnover in the homes. They tend to be lower capital than apartments, office, retail, right? In terms of having to reinvest into the properties every year. Usually you only need to do your capital reinvestment in a major way the first year. But the problem is you do all that and you try to increase the market, the lot rents to market, and the tenants just can't afford it. Even though the demand is through the roof, they just top out at certain incomes here. So I always caution people to be very careful in the Midwest. You just got to be picky. In a market like Columbus, Ohio is a great example of go for it. Great market, strong incomes, good growth. But in the South Illinois area, you can get killed because people just don't have the incomes to support any lot rent increases. And you have to keep increasing lot rents in order to deal with expenses and of course keep up with inflation. New York, you just have to have a high pain tolerance. You have to almost be uh, you almost have to just think, hey, I am going to build out the best team in New York. We're going to, like California, get to know every single regulatory rule, and we're going to get these things at fire sales because we know we're going to run into all kinds of pain from a regulatory standpoint, more so than I found it on the West Coast. Uh, States on the eastern seaboard have almost a combative approach towards mobile home parks, and definitely would prefer they don't exist. So I would just be very careful in these markets. This is once again a market where you want to either specialize and just get laser focused on certain areas where you can, you know all the little tricks and get to know the city officials in those markets versus just trying to, do this from 2,000 miles away from California or 3,000 miles away from California would be a bad idea as a first investment. That's for sure. Okay, the Southeast, a lot of turnaround opportunities, a fair amount of park owned home focused parks, just because it was more accepted to have that business model in the Southeast. And part of that was because for a long time, the lot rents were just way too low. I mean, we're talking $200 lot rents in a market where the apartment rents are 1,500, 2,000, and because they just weren't pushing them. The mom and pops weren't pushing lot rents. And so people would figure out, well, in order to be able to pay these expenses, I need to make more income. So I will actually start owning the homes. So there are plenty of opportunities, a ton of parks in this area of the country. You tend to have a park owned home business model, or at least the ability to deal with them in this market. Or you can just focus on maybe smaller parks. There's plenty of smaller parks in the Southeast, and a lot of them are desperate for capital. And so a great strategy I found is kind of the small ball strategy of picking, okay, we're going to focus on these three MSAs within a short driving distance, and we'll just buy up a bunch of small parks and we'll aggregate them as a larger portfolio. Florida, specifically South Florida, is going to be more of an expense control exercise. You're not going to have any demand problems. You're mostly just going to be worried about obviously weather and insurance costs going through the roof. They do have a little bit more of a regulatory hurdle to get over. In Florida, you have to submit a proposal to increase the lot rents. Some people would argue it's more a formality, but still, it's not as easy as investing in other red states. The Deep South is really challenging. It has the most hair, I would say, of any part of the country in terms of the quality of the mobile home parks, the quality of the infrastructure, and the difficulty of the tenant base. You can pick your spots, right? A lot of people ignored Alabama, like great markets, great cities like Birmingham, Tuscaloosa for years. And the people that were kind of brave enough and had a viewpoint of those markets, which are great markets, great cities, they have made a lot of money. So you can find opportunities here because some people just redlined all of the Deep South. Hey, we're just not going to invest there. But just be careful. There's more hair than usual, especially from an infrastructure standpoint. The Texas Triangle, Phoenix. Once again, you're probably not going to have demand problems here, right? You're going to be able to push lot rents because the incomes are high to get them to market. But you're once again from a value add strategy, you're going to have to drive returns from more than just passing out a rent increase notice. So I think of these markets as because you're also not going to get them for a steal. You're going to have some competition to buy parks in these markets because they're popular. So then your alpha has to come not maybe less from the buy side and more from the operational side of the equation. And then Hawaii, I wish there was mobile home parks in Hawaii, but alas, they still do not have them, which is weird because it's kind of a perfect market for mobile home parks because they need affordable housing there. It's a bit of a crisis. All right, now we got to match up the park, the market, the strategy with the operator and the operator's capabilities. Right? And so here's a really basic, fifth grade type of framework of how I personally think about joint venture operators that we like to work with and categorizing them. And I think of any deal where the track record's great, the amount of time and experience that operator has in the space. They're not a tourist. They've made a real commitment to the space, and it's in a great market with low complexity, right? So high simplicity here, right? Upper right corner, real easy to do deals here with operators all day long. Pretty easy to do one and trust an operator if they decide that they're going to go for a slightly softer market, right? Within reason, of course. And they're going to go with a more operationally intensive strategy, like a park owned home conversion strategy. If there's a history of them doing that, if there's a history of great returns in that specific market, that's a green light as well. Where you get a little bit of concern is, okay, we have a newer operator, emerging managers in this space, are pretty common because it's not apartment buildings. There's not 1,000 institutional quality groups. It's pretty nichey. It's pretty small. There's only maybe 10,000 parks in the country that you would probably want to invest in. Most of them are quite small. So if it's a newer operator, not as developed of a track record, that better be a fantastic market with with a really simple business model. You don't want any hair, you don't want any complexity if you're stretching a little bit on the emerging manager. And then if you got a bad track record, a low experience, and a bad market, obviously it's a no-brainer to avoid. All right, getting into the sourcing framework of buying these things. So, and this is a great analysis from when talking with our partners and thinking through how are they finding these deals, because you don't want somebody that is just buying off LoopNet, of course, right at full market price. So no shortcuts to sourcing, as many of you know, in other real estate asset classes, that works the same here. It's kind of an art, right? You got to pound the pavement is the main theme here, right? Industry conferences, there's a big one in Vegas or Orlando. Got to meet the players, got to meet the mom and pop owners that just like going to this thing every year. You're going to have some kitchen table negotiations. I've sat across many mom and pop owner who want to shake the person that's buying their park's hand, right? Maybe their father developed the property. Maybe they developed the property 30 plus years ago, and they don't want to just hand the keys to somebody that's going to triple the rent in 3 years or kick all the tenants out and redevelop it right away. So they often, care. Obviously, they want to maximize sale price, but they often care about more than just the pure economics of the deal. So how do you meet these people? How do you reach these people? A lot of people do mailers, database management. Some people are already starting to use AI. All that's well and good. It's not the distinguisher it once was, but the reality is that you just got to be at the right place at the right time. There's so many deals I've seen happen where we were reaching out to this mom and pop owner for years, and then all of a sudden, like somebody randomly, met them at a coffee shop and inked a deal after they said they would never sell. So it is definitely a timing aspect, and I've been the recipient or the beneficiary of the opposite side of that, where somebody's been mailing mom and pop for 20 years, and I happen to be the right place at the right time and sign the contract quickly. So you just have to have multiple ways to reach these people, reach these deals. I think the best players in the space are very good at structure, are very good at joint ventures in order to see more deal flow. That's certainly what we focus on because, like I said, only 10,000 of these parks. Most people understand what they own and the long-term benefit of holding these, so they don't trade that often. And so you want to see more deal flow. You want to have partnerships. Maybe you don't have full control, but you get to see more great deals. And I think a lot of operators that excel in the space have that framework, have that state of mind. And then, this point on getting known for closing on time, one of my favorite strategies was just being known as somebody that's going to close and do what they say they are, because you want to be, if you're not the highest price on a pocket listing, maybe the broker went out to 3 groups. If you lost, quote, in the bidding process, and that first buyer blows out for whatever reason, that broker is going to call whoever they think is almost 100% sure they're going to close, right? So, because they're not going to get a third bite of the apple of trying to sell that asset. They know maybe they get the first miss. The mom and pop seller is going to give them a little bit of grace, but they're not going to give them a third attempt. So that's often a great way to get a discount. because you have the broker advocating for you, even though your purchase price might not even be as high as maybe the third or fourth bid. And we talked about the regional roll-ups, even small ball. The scatter shot, buying in 30 states, one park in each market is a very difficult strategy. Obviously, not only from a day-to-day operations, getting your regional managers out there to see the properties, make sure they're being maintained, but certainly if you want liquidity someday, if you want to sell the portfolio, what is that next buyer going to do with it if they don't have existing operations in every one of those markets? So regionally focused clusters are great. All right. And another great way to just find good deals is being a great operator. Because once you have an edge, you can actually, quote, overpay for maybe a deal that was broadly marketed, but you know exactly what your team can do from an operational standpoint to actually make it up on returns through operations, through NOI growth, through occupancy gains. You're going to get looks at off-market looks from people that just need a better operator than they are to partner with. Maybe it's an operator that got some random lead, but they don't have a portfolio in that market, and so they'd want to partner with you, and you've become known as a great operator in this space. I found this is a unique way to get deal flow. And then you could also focus on the actual the price per pound. We call it price per pad, the basis of an asset versus the cap rate. CRE Dailies kind of known for no cap, right? Podcasts. I take the same approach with mobile home parks. The cap rate is fairly meaningless to me because mom and pop tend to run these things a lot differently than a professional operation would. Sometimes you'll see crazy expenses like health insurance and car payments for the entire family in the P&L from mom and pop because they're trying to shelter income from the tax standpoint because they've blown through their depreciation schedule, right? Obviously, that cap rate's not going to be applicable to your NOI once you brought in professional operations and are running things the right way. All right, so what doesn't work? We've talked about what does work. Inverse, right, is a great way to think about what we actually want to do in this space. So, what doesn't work? The cash grab in soft markets from 2,000 miles away. This is somebody that falls in love with a thesis, thinks that they can just hire some tenant in the park, pay them 15, 20 grand a year to collect the rent and enforce the rules and handle the maintenance and deal with the utilities when there's an issue. Like this is a pipe dream. This doesn't happen. You could get away with this maybe 10 years ago because you just bought it for such a dirt cheap price that there was ways to, deal with the problems that this strategy, this philosophy would ultimately lead to. But this doesn't work real well today. All right. You have to be operationally driven. This is a pros market. So you can't ignore deferred maintenance. We'll talk a little bit about it, infrastructure in a second here. And you can't, it's really difficult to just pass the keys to a third party manager and say, hey, you run the deal. It's a lot easier to do that in mobile home park, or sorry, in the apartment world or in self storage. There's just more third party managers. There's less moving parts. It's just more efficient to run those types of assets than it is a mobile home park that has a lot of weird quirks. And so the third party managers, because there's not a great one in every market, it's very hard to just hire one nationwide. If you have scale and you're really good in acquisitions, this is a backup option, or you're just so big that the third party manager is going to give you and your properties way more attention than just a one off syndicator. But I've seen a lot of people get in rough shape by thinking they could just focus on acquisitions, buy their first couple of parks, outsource third-party property management, and really they're just great at kind of babysitting, keeping the wheels on, as opposed to driving real operational growth. And beta, right? Just what doesn't work is just going to LoopNet, buying a park that's gotten 30 plus bids, and just passing out a rent increase notice, of course. So alpha, you got to drive alpha through a fix and fill that's bringing in homes to increase occupancy on any vacant pads. That's fixing some of the infrastructure issues, if there is some. That is getting the lot rent to market, fixing the roads, maybe replacing some pipes if you have to. Expansions are my favorite from an infill standpoint because it's all net new income, and generally you don't have to pay for any expansion rights. It's rare that you're going to pay some giant per acre price for expansion land. Oftentimes the park will just come with it, and you can either subdivide it if there's a stick-built home on the property, which is pretty common, that because mom and pop lived on the property, right, in the nice home that was a little bit removed from the park, and then they could oversee and be the mayor of their mobile home park. But oftentimes you can get rid of that home and turn it into more pads, which is obviously alpha driving activity. Vertical integration we talked about, park owned home conversions we talked about. Not everybody can pull that off, so that is a real alpha generating strategy. Simplifying messy deals, that often means maybe there's a gas station or a convenience store or a restaurant at the front of the property that's on the same parcel. Most operators and lenders don't like to see that. And so if you can subdivide and maybe simplify that asset, that adds value to the property as well. And then we've talked about infrastructure upgrades. Generally, the first thing we like to do with our partners is the roads. The roads are just a very visual, very immediate, and not a crazy expensive way to say, hey, look, new owner in town, we're upgrading the property. You're going to get something for your lot rent increase. We're not going to just increase rents without reinvesting in the property. And it's just kind of a nice way to kick off a new ownership group. Speaking of infrastructure, so you need to think about infrastructure in tying it to the market when you're going to evaluate your diligence, because it's really density specific, right? If you have a mobile home park in, say, South Carolina, where there's plenty of space, it's maybe 45 minutes outside of an MSA, you're going to have larger lots like up here in the right-hand picture. And you're going to be able to do a lot more creative things with infrastructure. Like you're going to be able to go out on the risk spectrum with the type of private utilities too, with a space like this, a park like this. You can use septic here, right? Because if a septic field fails, it's kind of not a fun conversation, but if it does fail, I mean, think of Meet the Parents, right? That movie where in the backyard, the septic tank, the field failed, right? So if that happens at a mobile home park with space, not a big deal, right? You just kind of move the leach field. And you have usually 1-to-1 is pretty common. So your risk, your capital is not tied up in one main system for the entire property. It's diversified by 100 different septic systems, or maybe it's 2-to-1, 50 septic systems. So that is risk that we can bracket. Like we know exactly if all goes to hell with the septic systems, we kind of know what that cost is going to be. That's a real problem though if you don't have space. If you are in an infill location like the bottom right here, you cannot just immediately move a leach field, of course, and there's not enough space to fix things. So you have to actually dig up the roads. You have to dig, God forbid, the lines are underneath the homes. I've dealt with that before. That's a real nightmare. You can sometimes figure that out by the drawings here on the lower left-hand corner. If you can see the sewer lines, if they happen to be running below the homes, you kind of know that you're going to have some very expensive repairs, because literally they have to either move the home, that's not fun, or they have to get on their hands and knees, the repair guys, and dig into underneath the home to repair any bellies in the sewer line. So these are just some diligence items, but once again, the infrastructure, you need to tie it to the type of property, the amount of space you have. Roads are pretty similar, either one, but you're going to spend more on roads in a less dense park. Of course, there's just more square footage for the roads. And then packaging plant, lagoons. Life's too short, man. These things I think would keep me up at night, thinking about like one of those failing and having the EPA, sending us notices for fixing that private treatment plant. I think it's just better off avoiding those. I mean, if the deal was extremely large, a packaging plant, especially if it's brand new, is basically just like a small city sewer facility, just like any reasonable city would how would they would maintain their town. You have one of those units at the park, but that could be $1 million expense line item if it fails. So it's got to be a very big park with an institutional capital partner that can write that check if it does fail. But once again, I tend to stick to city sewer, city water, maybe septic, and maybe well if there's some backups, right? If there, where the city lines are, if it's in close proximity, generally that's something you can work with because you know exactly what you do in the worst case scenario. All right, tax alpha. We're not going to get in the weeds here, but this is really counterintuitive because most people think of a mobile home park. Well, we own the land, the tenants own the home. You can't depreciate land. But the great part about mobile home parks is that it's the infrastructure, what we just talked about. That's where the real value is in the roads, the pipes, the driveways. That's all land improvements, which is on a 15-year depreciation schedule. You can obviously bonus that. It looks like we're going to go back to 100% bonus. We'll see, but the tax bill currently contemplates going back to 100% bonus depreciation indefinitely. So that generates some unreal after-tax alpha from a return standpoint. Oftentimes 500 basis plus more to the after-tax IRR, and especially if you're a family office type or a private or a wealthy individual, accredited investor that doesn't want to flip these things in 3 years and have that depreciation recapture. If you can hold longer term, then this is very compelling from an after-tax standpoint because you buy it, you do the bonus depreciation, you do a refinance year 3 to 5. Oftentimes that's what we've done on most of our properties, and then all of a sudden you have no at-risk capital and you're able to continue to defer those taxes, right, for indefinitely because the properties are cash flowing and have no more of your capital. So that's a great deal. When it was at 40%, if for whatever reason that doesn't pass, it's still compelling. The math here is about 50 cents on every dollar that you are investing, right? Comes back in that first year. Paper loss, if we maintain at 40% bonus. But once again, if we go to 100% bonus, you're kind of looking at dollar for dollar in terms of you invest $1, you get back a dollar of after tax, you get back a dollar of losses that you can use to offset against other capital gains. All right, lessons learned. From an operating standpoint, and partnering with other groups and knowing what we were ultimately good at and what I see other firms excel at, these are just some takeaways. Number one, the best operators build systems that they consistently implement without having to think and make decisions. It's just this is the system. And then they seek to continuously improve those systems. They tweak them every year. So you want somebody on the team that has an engineering mindset, that has a very detail-oriented disposition that can build out these systems that your team can rely on regardless of the property. They just know if this happens, we do this, right? And so once again, this is not hard. But it's not simple, right? You have to spend time improving these systems, putting them in place, getting to know the local property management, leasing regulations, importing those into your lease documents, tying that to your property management system, making sure that system can then go out in the field with somebody on their cell phone when they are doing a overview of the park, and they can reference, okay, this lot 5 needs to have their skirting updated or their lawns mowed. We have to issue a notice. Then tying all those systems together with your accounting, right? This is all basic property management stuff. But the problem is, like I said, you can't just hire a third-party manager in every market that's going to be great. So you have to build out these systems yourself, or your operating partner has to be very good at this. So that is the number one, what I would say, key to operations is just making sure you're thinking about this in a mechanical, automated way, and then constantly trying to improve them, never getting complacent because things change. The best operators prioritize and develop talent within the organization. They look for new talent outside the organization. This is just like any other great company. It's all about your team. And then, like I said, I think the the teams and the operators that have a growth mindset and a willingness to partner tend to see better deals on average. The best operators are not capital constrained in terms of, hey, they barely raise enough money to get the property over the finish line, and they don't have any amount of capital to deal with surprises. The best operators use their balance sheet, or maybe it's a private equity fund they partnered with, or it's a fund that they put together. They use that access to capital, sorry, to really drive returns post closing. And when opportunities pop up, like sometimes you can make a deal with the city to gain extra spaces, expand the park, if you're only willing to pay for that, of course, right? Or maybe you can take over the maintenance of the roads in exchange for those extra pads, or in exchange for maybe they are going to take over the water billing, which is a huge benefit to a park to not have to be in the utility submetering game, right? So they use capital as a weapon to buy new homes, increase occupancy, make improvements that allow them to raise their rent. So access to capital is very important. The best operators are not afraid to go to markets that maybe you're scratching your head initially, coming from a more traditional real estate asset class. Like you would never think to buy an apartment there or a retail center. But because the thesis is so compelling and because the need for affordable housing is so strong, there's markets that most people would consider, BFE out in the middle of nowhere, even though it's 100,000 MSA, but it's just a town that you wouldn't think of as a secondary or tertiary market, even that actually can be quite attractive within reason. We kind of talked about you can't go just anywhere, but the best operators are kind of willing to be on the forefront of what is an acceptable market. Like I said with Alabama, I think some operators moved into Alabama in a meaningful way in the major cities around college towns 7 years ago, and have done quite well. And there's other opportunities, in South Carolina, North Carolina, Tennessee, certainly to do that as well. The best operators embrace this concept of, the broken window theory. This is how New York was turned around, right? It's a criminal theory about, hey, if you take care of the small details and you show that, we're going to enforce the little things, then the big things like rent collection, stay on track, and people don't start to bend the rules and then all of a sudden stop paying rent or leave their broken down car in the lot or not mow their lawn, right? It's the idea that if you're taking care of the property, the tenants are going to take care of their homes, and they're going to take care of you as the operator in that asset from a behavior and a payment standpoint. And then cluster assets, right? We talked about this. It's not scattershot. It's laser focused on, maybe they start with one core market and branch out to two to five. And they do a cluster approach. Miscellaneous lessons learned. Once again, we talked about price per pad plus the market. That is more important to me versus the going in cap rate. Due diligence is more of an art plus science than it is just a science. Sure, you got to trust but verify and get in the weeds on receipts for rent and recreate P&Ls and all that important stuff. Make sure the infrastructure is sound, that you have the water and sewer lines looked at, the sewer lines scoped, right? All that, basic diligence you got to do. But the art part of it is knowing what to overlook and what to live with. Because once again, there's not that many of these things, and the structure of this industry is such that the homes don't really move, so the tenant turnover is really low. It's just a good business model, and so if things aren't perfect from a diligence standpoint, it's kind of knowing which of those things to still move forward on. Move fast when opportunities surface. You don't want to be underwriting these things for 3 weeks to submit your offer only to find out that Pops sold it to the first guy that called him that day that he decided to sell. You want to move fast when something hits your buy box. On both an LP and an operator, asset purchase basis. And then sad market, it's just like something maybe in the Rust Belt where there's no job growth and there's population declines. That's why I defined a sad market. And with old homes and not enough capital to defend the park is a recipe for disaster. It equals the death spiral where you just start bleeding occupancy and you don't have a way to reinvest back into maybe a home that got trashed when a tenant left. And so this is a great way to lose money if you go to a sad market with old homes. All right, so that was my very quick framework presentation. Well, I guess that was 50 minutes, but I tried to fire through it. Um, Maybe we'll hit on one of these thesis points here before we get in Q&A, just to make sure the people that don't know this space as well understand what I'm talking about when I talk about the advantage business model of mobile home parks. 57% Americans are living paycheck to paycheck. We have an affordable housing crisis. Most people in retiree age do not have any meaningful savings for what is probably going to be a lengthy retirement. And that's the median here is 175. There's plenty of people that have zero. So the original intent of mobile home parks was, affordable, respectable, professional value, right? This is what a mobile home park was offering. It was another way for a retiree to extend their retirement without as much savings because they didn't have to own this giant home that they couldn't no longer maintain or had no desire to because the kids have left. They could sell that property, they could buy a mobile home outright from cash, and they could reduce their housing costs by 80%. That still exists today. That is the vision that we are pursuing, that we want, affordable, respectable, professional parks that offer a great, valuable service. It's not about trying to take advantage of this dynamic. It's about delivering a great product to the end user. There's not any more of these things being built. That's the great thing. We have huge demand, but yet no new supply. That's a very interesting place to be on a demand supply curve from a pricing standpoint. They're recession resistant, right? They're not as impacted by a recession because it's the last stop on the affordable housing train. Whereas, of course, on the other end of the spectrum here, hotels are very impacted by changes in GDP. And then last point here is that the tenant turnover for apartments close to 50%. Mobile home parks, the homes don't go anywhere. The home turnover is like 2%. That's a way to think about the actual tenant because you can resell a home fairly easy in a great market or re-rent it if it's on your balance sheet. And then your capital expenses. Once again, this is after kind of a bigger capital refresh push, like doing the roads, maybe changing some of the piping, or adding park-owned homes. But on an ongoing maintenance standpoint, because you mostly own the infrastructure and land versus a structure, your ongoing capital expenses as a percentage of revenue is quite low. So that really rounds out the current the state of the thesis. Here's just some things that are pertinent to the industry today, like expense pressure. I think all real estate's seeing that from an insurance standpoint. Got to be on top of that. Solving the capital stack. That's because it's really hard to get debt above 50% in this space if you're buying from mom and pop operator and the lot rents are artificially low. You can solve this with pref equity. You can over raise. You can get seller financing. Deferred maintenance, we talked about that. You can't just ignore the infrastructure and hope that it's going to outlast your hold period and you're going to sell it to some other sucker who they will have to then deal with the infrastructure. That game is, I think, toast. I think you're trying to rely on a sucker on your exits, not a great business strategy. And plus, we're focused on maintaining and owning these things for a very long time. Like my preference is always if you find something in a great market, yes, you maybe put in a structure to get some investors liquidity, but you also, why would you want to sell something where you have refinanced all your capital, the demand's through the roof, you can consistently raise lot rent increases and generate a lot of cash flow and keep deferring that initial tax benefit. So we're very much focused on long-term holds if we can find them. And with that, we will go into questions if we have any available. And Ian will help us out. Hi, Ian.
Yeah. Hey. So we do have a couple. I guess I'll just jump right in. So first one, how does experience in multifamily ownership and management translate into MHP? Are third-party management companies with proven track records readily available to run the parks?
So there are a couple of very good property management companies, third-party property management companies that exist in this space, but they tend to have a regional focus. Like California has got at least four of them. Michigan's got a couple, but it's not like apartments where any market you want to go to, there's five guys and teams to choose from, unfortunately. And that's especially true if you want to do a more aggressive business plan. There's more of a turnaround. A third party property management company is not going to be able to do that really well. Like they are very good at 100% occupied properties in great markets where they collect the rent, they enforce evictions if people are not paying, they maintain like the grounds, the landscaping, like just the absolute basics. But if you're asking them to do more, that's very difficult in this space, which is one of the benefits and why we're able to generate outsized returns is it's not as easy for most sponsors to pull these value add plans off.
Correct. Um, okay, let's see here. Has the tiny house phenomenon made its way into maybe difficult infill locations where traditional mobile homes may have struggled politically?
Yes. So in certain markets like the Pacific Northwest, you're starting to see more tiny homes. You're starting to see it in converted RV parks, right? Because technically a tiny home is an RV. By definition, it's not going to be, it might have skirting in a park, but it's not going to be, have the same tie downs. And so it's not going to have the same classification. So that is a way to try to drive operational improvements because if you can replace an RV with a park model, which is just a tiny mobile home, right? Um, a tiny home. So if you can replace an RV lot, which obviously the RV can leave at any time, you replace that with a park unit with a permanent tenant, increases the value of the property.
Okay, what is the typical GP and LP split on your deals?
Ian, you want to tackle that one?
Yeah, sure. So I guess the context for this is that for a long time, high quality operators in the space that one would want to invest with that have been frankly spoiled for options for investors. So from a capital market, supply demand perspective, that's been a challenging dynamic to a lot of LPs. I think over time that has somewhat equalized as less capable operators have been weeded out, and as more capable operators have wanted to continue scaling, I think that's somewhat normalized. So what it means is that there's typically, call it a 20% uh, uh, promote over a typical 8 or 10, preferred return, and then perhaps there's some upper tiers, above a 14 or 16 that may go to 30, 40, maybe even 50% as you get over a 20 IRR, those types of numbers. Um, okay, and then the last one that we've got for the moment, what are some of the more common issues that are surfaced in an environmental phase one assessment of a mobile park?
Underground storage, um, tanks, right? Every once in a while, you get somebody that just buried a gas, tank for whatever reason. Um, Heating oil in the Northeast that can cause some filings on phase ones. Generally, it's been pretty. I think I've only gotten two or three in my entire career that came back as failed the first phase one and had to go do core samples for phase two. And one of those, it happened to be like downstream from a some sort of military facility in Ohio, which was a random one. But for the most part, these things aren't because they're not next to the gas station or the dry cleaner downtown. They tend to be on the edge of the city and where there's not too many environmental issues. All right. Well, with that, I wanted to thank everybody for joining us today. We certainly went in the weeds on frameworks and strategies. If you want to learn more, we've got a ton of resources on our website. You can certainly reach out with questions. We have a fund that invests in all our properties that you can participate with us if you want. Shoot us an email, info@vintage-funds.com. Our head of investor relations will get back to you. Check out our website. And thanks for sharing your time with us today. And we'll talk to you later.